larger your tax refund is, the more money you get to keep and put straight into your bank account. But most people have no idea how to maximize their refunds, and therefore they end up leaving thousands of dollars on the table each and every year. And if you don't want to give more money to Uncle Sam that you have to, and you would rather keep more of your cash instead, then keep watching this video. I'm going to break down the top 10 tax tips that you could use to maximize your tax refunds. So make sure you stay all the way to the end of this video, because not knowing any of these tips can cause you to miss out on a lot of cold hard cash. But before we get started, I want to introduce myself. My name is Ricky, co-founder of Ricky and Nick Accounting Services. And what we do here is we make taxes very easy to figure out. So make sure you stay tuned, subscribe to the channel, and follow me on all my other socials so you don't miss out on a bunch of tax saving tips. All right, so let's dive straight into this video. So what are tax refunds? As a reminder, tax refunds are refunds that are given by the IRS to people who tax withholdings exceed their actual tax liability for the year. Every single year, hundreds of millions of Americans qualify for tax refunds. And generally speaking, the more you can reduce your actual tax liability, the higher your refund will be. A wide variety of tax deductions and credits can help you lower your tax burden and therefore potentially help you boost your tax refund. Here are 10 of the best tax deductions and credits to boost your tax refund and keep more of your hard-earned money in your bank accounts and pockets. Number one is the mortgage interest deduction. Roughly 42% of American households have mortgages. This translates to about 51.5 million households. If you have a mortgage, then in most cases, you'll be able to use the mortgage interest deduction. The mortgage interest deduction is available to taxpayers who choose to itemize their deductions. This deduction allows you to deduct mortgage interest you paid during the tax year on your first $750,000 worth of principal for joint filers, or $375,000 for single filers, or either your first or your second home. The $750,000 limit was added in the Tax Cuts and Jobs Act, and it is scheduled to revert to $1 million in 2025. This means you'll be able to deduct even more mortgage interest in the coming years. We're in 2024 now, so it'll be right there. Number two is going to be the home office deduction. Ever since the pandemic started, more people than ever have been working from home. In fact, currently 41% of the workforce is working from home, and at least some of the time. If you work from home, then you might be eligible for the home office deduction. The home office deduction allows you to deduct certain expenses associated with using the space that's strictly used for business in your home. Now, there are a number of rules for the home office deduction. For example, the home office deduction is generally not available to employees. So if you're trying to take this deduction, you need to be a business owner. Second, you must use the home office exclusively and regularly for business. There are several different ways to calculate the home office deduction, but it is common for this deduction to be worth $1,500 if you're using the simplified method, or even more depending on the size of your home office and whether or not you choose to take the regular method for calculations. Number three is the student loan interest deduction. About 43.5 million people in the United States have student loan debt. So if you have student loan debt, you need to be aware of this deduction because it's very helpful. The student loan interest deduction allows you to deduct up to a maximum of $2,500 in student loan interest paid from your taxable income. So for example, let's say you had taxable income of $50,000 and you paid $5,000 in student loan interest. In this case, you'd be able to deduct $2,500 as a maximum from your taxable income. This will reduce your taxable income to $47,500, which means you just reduced your taxes by nearly 5%, which will give you some nice tax savings. Now, Number 4 is maxing out your 401k or your IRA. If you max out your retirement account, such as a traditional 401k or a traditional IRA, then this can reduce your taxable income as well. This is because these accounts are funded with pre-tax dollars, which means the money that goes into the accounts before they are taxed. So once you contribute to them, your 401k or your IRA, your overall taxable income is subtracted from these contribution amounts. Now for 2023, the contribution limits for employer-sponsored 401k is $22,500 or $30,000 if you're age 50 and older. The contribution limit for traditional IRA is $6,500 or $7,500 if you are age 50 or older. But keep in mind, you guys, that contributing to Roth 401ks or Roth IRAs is not going to boost your tax refund. Only contributing to traditional 401ks and traditional IRAs will. And this is because contributing to Roth 401ks and IRAs are made with post-tax dollars. So they do not reduce your taxable income for the year. However, Roth 401ks and Roth IRAs provide tax benefits later on when you withdraw during your retirement. This is because you can withdraw this money tax-free. Now, number 5 is going to be charitable contributions. Did you make charitable contributions this year? Well, if you did, then you'll most likely be able to deduct them. Charitable contributions to qualifying institutions are tax deductible to taxpayers who itemize their deductions up to a certain limit. Currently, this limit is 60% of a person's adjusted gross income. So if you're someone who is donating to charities or to churches or to nonprofits on a regular basis, then these donations can potentially help you to increase your tax refund. Just remember, if you're going to deduct charitable contributions, make sure that you keep your receipts. Again, keep your receipts just in case the IRS decides to audit you. Now, number 6 is going to be maximizing your HSA. And if you never heard of an HSA, I want you to listen very closely. It stands for Health Savings Account. With an HSA, it is very similar to a 401k, but instead of helping you fund your retirement, it helps you fund your qualifying medical expenses later on in life. But just like a traditional 401k, you can make contributions to an HSA on a pre-tax basis. This means that your taxable income for the year will be reduced by the amount of money you contribute to the HSA. However, just like with a 401k or an IRA, there are limits to the HSA, and currently the limit for contributions are $3,850 if you have health coverage just for yourself, and then $7,750 if you have health coverage for your family.